Hey, welcome back. It's Nolan Mathias from Mortgage 360, and today we're discussing the Bank of Canada's surprise announcement that they're moving up their timelines with respect to increasing interest rates. We're going to talk about what that means for the economy, what that means for you if you're getting a mortgage, and what you should be doing with your existing mortgage if you already have one. We're going to talk variable versus fixed, all the fun things. But before we get into it, do me the favor, hit the subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where one lucky subscriber is going to win their rent or mortgage payment for a month just for subscribing to this channel. We're only 500 people away from giving that prize away. So it's going to happen in the next 2 or 3 days. You have to be subscribed not only to win, but to find out what you have to do in order to win. So go ahead. It's free. It's easy. It's definitely worth it. And make sure you follow up after that. Don't unsubscribe after we do the contest, because there's going to be another contest that's even better coming up. The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss the Bank of Canada's meeting this morning and what they said with respect to interest rates and bond buying going forward. Obviously, this was the primary meeting. Tomorrow, Tiff Macklem is speaking as well. There's probably going to be more details with respect to the economy coming out in the next couple of days. But for the most part, the news is this. The Bank of Canada is scaling back its bond buying from $4 billion a week to $3 billion a week. And they've moved up their timeline with respect to when they think interest rates are going to go up. So, let's jump right into it as we always do. Take a look at the news. I found this really interesting, and I just wanted to point out that when you go ahead and you do a Google search at any time when the Bank of Canada does a policy release or a policy meeting, you can almost always find the news instantaneously about what's happening. A lot of times the media outlets kind of have an idea what's going to happen, so they pre-write the article. I don't think anybody expected Tiff Macklem today to say that they were going to move up the timeline for increasing interest rates till the end of 2022 from the beginning of 2023. And if you go ahead and you take a look at the news articles here, you can pretty much see that the ones that are showing up, the only one that mentions moving up the rate hike to 2022 is the actual Yahoo Finance page. And you can see some of these were done prior to the actual meeting. But, interesting that, take, for example, CP24, whatever news outlet this is, don't even mention the fact that they are looking at moving up the timeline for increasing interest rates. This is big news. This is a big policy difference. And as always, I tried to find another media outlet that would cover this as well. I looked at all these articles. I can't do it. BNN, Bloomberg always has the best coverage on things like these. So I want to point out their article and specifically their commentary with respect to a new timeline. In what they say about the new timeline is this. In new quarterly economic projections, it revised higher its growth estimate for 2021 by more than 2 percentage points to 6.5% and brought forward its forecast for when slack would be absorbed. Based on the bank's latest projection, this is now expected to happen sometime in the second half of 2022, referring to when they see interest rates increasing and going back to some sort of normalized policy. Now, what I found interesting here is this 2 percentage point increase in expected economic growth, which I think is absolutely amazing. What that means is that everything that's been happening in the economy with respect to incentivizations, with respect to monetary policy and fiscal policy has spurred on the economy. It is creating an expectation that things are going to get better faster. Combine that with vaccinations. And what they're basically saying is that we can expect growth in the economy and that things are going to get better sooner rather than later. Now, with respect to interest rates going up in 2022 and normalizing in 2022, what does this mean? Well, I don't want people to think that that means that there's going to be a 4 or 5% interest rate jump in 2022. They're going to start to move towards normalization. And if you read further on in some of these articles, it talks about the fact that it is going to take a significant amount of time, and Tiff Macklem comments on this, for things to get back to normal. This isn't 2022 happens and then by 2023 we're back to normal from a monetary policy standpoint. That's not how it works. It's going to take time. The last time it took time to do this was when the 2008 financial crisis happened, and it took almost 10 years to get back to normal. And then all of a sudden, guess what? Pandemic happens and we're back down to low interest rates. So it's going to take time for things to get back to normal. Could it be expected that we are going to see things get back to normal a little bit faster than in 2008, 2009? Yes, absolutely. That's definitely something that is possible. The reason why it's impossible is because there is significantly more money being injected into the economy. But there's a whole bunch of things that we have to consider when we consider how fast this could possibly happen. And first and foremost, I think is we have to watch what's happening in the United States, because if the Federal Reserve Bank doesn't increase interest rates in 2022, I think it becomes very hard, even if Tiff Macklem wants to increase them in 2022, for him to actually go ahead and do that, because it would have a significant impact on the Canadian dollar. If we raised interest rates first, our Canadian dollar would become more valuable, more expensive. And when that becomes more valuable and more expensive, it basically creates a scenario where our goods are more expensive to other countries. And since we are a net exporting country, that is bad, because what that means is that other countries will purchase less of our goods, which leads us back to lower interest rates again, because the goods are not being purchased, growth goes down, and you have to account for that in your monetary policy again. So there's a whole bunch of things that we have to consider. And I think that the key thing that we have to consider is this. Hey, so before I tell you what the key thing we need to consider is, I just want to jump back in here real quick and mention that if you're a first-time home buyer and this all seems overwhelming and complex and all that jazz, I don't want you to feel overwhelmed. I don't want you to get scared out of the market. We're putting together a first-time homebuyer boot camp. It starts on Monday, the 26th. And in that boot camp, we're going to get you prepared for everything you need in order to purchase a home. We're going to talk about how to select a realtor, mortgage 101, financing 101, how to write an offer, how to make sure that you get a proper home inspection. Everything you need to know about being a first-time home buyer, we are going to cover in basically a 4-week period. The cost of that course is incredibly low. It's linked in the description below. It is low enough that it is accessible to pretty much anybody who can afford to buy a house, can afford to take that course. And most importantly, it's going to prepare you for everything that comes along with that process of getting that home and then home ownership after that. So if you'd like to be one of the original founding members, if you would like to be part of the creation of that course and that boot camp, by all means, click the link in the description below, and we would love to have you join us on the 26th. And I think that the key thing that we have to consider is this, is that when it comes to economies, historians are often wrong. They're often not in doubt, but they're often wrong. And the reason why is because when you look at how economies run and how they function, it's never about what's happened in the past that leads to the future, right? Like right now, everyone's thinking that low interest rates basically means that there's going to be high interest rates. Well, that was what was expected in the early 90s in Japan. And guess what happened? 25 years of really, really, really low interest rates, right? And what the point I'm trying to make here is that the things that we expect to happen typically aren't what actually happens. Because if what we expected to happen happened, then we'd all be really, really wealthy because we had a crystal ball, right? And if you look at economics and you look at what goes on in the world and you think about it from this perspective, nobody saw 9/11 happening. And then subsequently, nobody saw, as a result, the Fed Reserve lowering interest rates in order to spur on the economy after basically the most devastating attack on US soil in history. And then nobody expected that to lead to the subprime meltdown. Or I guess more importantly, nobody expected that to lead to a housing boom, which then led to the subprime meltdown. And then that led to lower interest rates again. It took us basically 10 years to go from pretty much zero interest rates back up by 1 to 1.5%. And then nobody expected the pandemic to happen. So all of these things, basically, when you find yourself in a scenario where you think you know what's going to happen, which is things like inflation or higher interest rates, what tends to happen in economies, what tends to happen in markets is things come up and things surprise you. And those things that come up and surprise you are what basically leads to the opposite happening of what everyone's expecting. So right now, based on the data that they have, the Bank of Canada is basically thinking, hey, we're going to increase interest rates in 2022. That's based on what we know and what our projections are right now. But we don't know what to expect in the economy going forward, right? We didn't expect a housing boom coming out of a pandemic. Nobody expected that. So how do we go about, and I have to add this in here, Evan Siddall didn't even predict that, right? He thought that the housing market was going to crash by 20%. He was wrong. He had to walk those comments back. And that was the president and CEO of CMHC, who should have his finger on the pulse of housing and be able to make the best prediction and the most informed prediction in the industry when it comes to the housing market. So all this basically comes down to we don't know what's going to happen in the economy. Could interest rates move up faster than 2022? Yeah, we already saw them revise today that they're going to move up their timelines. But could interest rates go up further down the road than 2022? Absolutely. Depends what happens in the economy. If we get some sort of another negative shock in the economy, yeah, we could be waiting longer for interest rates to go up. It's basically this game of trying to make our best guesses and then prepare for what actually happens. So that leads me into the mortgage conversation and, preparing for both the good and the bad, and which mortgage should we be selecting based on that. And, a lot of people right now, one of the articles had the CEO of a big mortgage company say, this is a really good time to be locking into a 5-year fixed. I don't think it is. I think that is bad advice because this is a point in time where we really don't know what's going to happen in the future. And as a result of all the variables and what's happening in the economy, I think we need to make sure that our mortgages are variable as well, so that we aren't paying things like a higher premium for the interest rate, or a higher premium if we have a 5-year fixed and we want to pay the payout penalty. Because what if housing prices go down and we want to get out of the property, but we have this massive payout penalty that puts us in a negative equity position? That's not something that we want, because we don't want to give a whole bunch of equity back to the bank. And we want to make sure that we have the flexibility to basically move with the market, because as we're seeing, things could go really good a lot faster than expected. We could also have something else that happens in the world and in the economy that makes things not go well, and therefore we end up in lower interest rates or in stagnated interest rates for a long period of time, which makes that variable mortgage the better option. So really interesting news today with respect to interest rates. If you want to find out how to get the lowest interest rates, and I think that's important right now, but not just getting the lowest interest rate, making sure that you get a mortgage rate that is flexible and not a discount mortgage, then I recommend you either contact us directly or go and take our course, my course. We'll put a 50% discount coupon code off the already discounted price in the comment section below, or in the notes below. And that will give you all the information you need to not only negotiate a lower interest rate, but also to make sure that you have a mortgage that has lots of flexibility and no landmines and surprises. So, with respect to today and the announcement, I think interesting information out of Tiff Mecklem. We're going to learn a little bit more in the coming days. And for the most part, if you've got a variable rate right now, don't go locking in your mortgage, because you've still got at least 2 years of low interest rates where you're going to lock in some savings by having that variable rate. When interest rates do start to move, if they start to move, we'll know in advance, and then we can start looking at locking in to 5-year fix or 3-year fix, and so on and so forth. So if you found this video useful, do me that favor, hit the subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about a race to 10,000 subscribers. You're running out of time in order to win, and we'll update you in the next couple of days on what you need to do on top of subscribing in order to actually get entered into that draw. Because what we want to make sure we do is that everyone who subscribes actually has an opportunity to win. So you're going to have to watch for over the next couple of days to find out how to do that. We'll see you on the next video. Cheers.